I mean, that brings us on quite nicely to the US dollar in general. It's at the dollar index is at a kind of 6-month high at the moment. Dollar is very strong. How do you see a continued strong dollar over the next kind of few months or towards the end of the year affecting global markets?
I really do think that could do some damage. And I think, strong oil, strong dollar. These are not good things for global markets. And I'm amazed that markets are not pricing more of this in, particularly in the equity markets, which seem to be, we've got the soft landing narrative, we're safe, they're not going to have to do anything harsh or silly. But there is still a danger of a recession in many of these economies. Now, recessions happen to have a habit of knocking on into each other. So the Fed is not immune to all of it. The US economy is not immune to all of this. And I think realistically, the dollar is showing up as this US exceptionalism at the moment. The data is head and shoulders above everybody else's, but some of it is beginning to roll over. Quite interestingly, Tom, we have PMI data, the preliminary PMI data on Friday. Unfortunately coming after the central bank meetings. But I think that's going to be a real heads up for markets about, particularly the service sector. We know the manufacturing sector is in recession. If the services sector starts moving that way, then we could be in trouble. But this strong dollar and strong oil at the same time, and one seems to be leading into the other. So does strong oil equal a higher dollar? It seems so. Then we've got a few problems because there's still big supply issues with oil, and this strong dollar could have a big impact on emerging markets as well. I
mean, in terms of oil, do you see, obviously we hit $95 on Brent crude. Do you see it continuing to rise throughout the rest of this year?
I think there's an issue here about supply and demand issues, obviously with oil, there always is. And supply is being restrained. The other thing you've got is the refining structures. So there's a shortage of refineries and we've got a shortage of diesel at the moment. So diesel prices are really starting to move. The interesting thing about that is as prices at the gas pumps in the US and everywhere else go higher, it feeds quite directly into inflation expectations moving higher, which brings me back to that commodity story about higher rates for longer. Are we going to have to see more hikes if inflation comes back? So diesel prices need to be segregated just from oil prices, but the factor is that those oil prices are going to have an impact and could keep the dollar bid as well. And I think that's a bit of a canary in the coal mine for some of these risk assets, to be honest, particularly equities, which aren't taking any notice at the moment.
I mean, you mentioned earlier rate hikes are a blunt instrument, right? And right now, inflation is being pushed up by supply side issues. So do they continue with the blunt instrument or do they just wait for the supply side to come down?
I think that's really quite an interesting question, but there are also some demand issues. It looks like demand is actually staying very high for oil at the moment as the Saudis and Russians are cutting production, which isn't helping, of course, and they know that. Is this a weaponization of oil? Good question. But I think realistically, the markets have got to sort of seize on where this is all driving from, and there is demand side issues as well, that we've still got a healthy economy, but also we've then got to bracket that with what's going on in China. If we are going to see, and it's a big if, a recovery in China, then demand for these raw materials are going to start rising. We have seen China already buying quite a lot of oil. I think they are preparing themselves for a recovery, but that is a fragile area. The property sector and all the rest of it's still worrying people with shadow banking risks and all the rest of it. But if China does get its act together, which is possible in the next few months, and data will confirm that or not, then commodities could change very quickly and move up very quickly. The market is not long, apart from oil. So if we see copper, iron ore, aluminium, steel, I mean, for some of the food prices, rice is still very, very high. Staples like that is concerning. So inflation can move in waves. The market believes the central banks are just about done. I think Goldman Sachs and JP Morgan suggested the Fed is done. I'm pretty convinced the ECB's done. I'm not sure about the RBA. I think they probably are as well. But the issue is whether we're going to see this demand drive again from China. If we do, then I think central banks are going to be very wary about what that does to raw material prices and commodity prices generally, oil, copper, iron ore, all these sort of things. And if that is the case, then central banks may want to keep the window open for further hikes going forward, because this could be quite influential. And China matters now. So we're poring over the data. I mean, not all of it is, well, some of it's suspect, possibly politically driven, but the general data like industrial production and retail sales, stuff like that, it's important to see if there's the domestic driven drive, and also if the global demand is picking up for some of their products. having said that, the geopolitical situation with China and the US, Europe, UK, and a few others is concerning. And this idea of the globalization that we have that's kept, peace and free trade alive for so many years is fragmenting. And that has implications. So we're already seeing the EU trying to onshore energy prices away from Russia. This is expensive, and it's also inflationary. So I think there's a danger on a macro basis that inflation could revisit us in quite a way going forward. But in the short term, I think markets are just keeping an eye on China, keeping an eye on those demand-supply dynamics in oil and other commodities. But the global economy needs China recovering fairly quickly. Not happening at the moment, but there are signs it may be stabilizing.
Do you see this kind of economic instability that's slowly bubbling in the background? How do you see that affecting gold?
I think it could be a positive for gold actually going forward, depending how much stress it is, because gold reacts more to stress than just inflation. But people will look at commodities as an inflation hedge. Gold sometimes comes into that. We're kind of mid-range. We bounced off the lows recently and held mid-range. I think there's a lot of indecision with gold at the moment. And I think realistically, for us to get a really big boost to gold, I think that there would have to be some kind of systemic risk again, like the banking crisis we had before. A big issue like that in China might do some of that as well. But the central banks, particularly China and a few others, have been buying gold as well. So there is demand underneath. But at the moment, I think for gold to really break higher, we're probably going to need an event. But there is this idea that, okay, maybe we do need to worry about inflation again at some point. The market believes we got peak inflation, which is fine. We may have. Have we beaten inflation? No. And the problem is getting inflation from 5% to 3.5% might be okay. Getting it from 3.5 to 2 is going to be something quite different. And I think this is where the central banks are going to struggle with their targets that they've got. Are they going to surprise markets by really pushing after this inflation goal, or are they going to be worried enough about growth to stall? At the moment, I don't think they know, so therefore we don't. They're certainly not signalling that. But at the moment, it looks like inflation is still the main focus. I think that's going to change. I think growth is massively important politically for a lot of these central banks. The idea of independence at central banks is still a myth as far as I'm concerned. But I think there's realistically a danger that the market's getting a little complacent about this narrative of a soft landing and, okay, interest rates are done, peak inflation's in, it's going back to target. I think that's a bit simplistic at the moment. And I think historically inflation moves in waves and there's a danger we get a bit of a kicker come back in, which could shock markets quite a bit.
When do you expect that could potentially happen? Would that be kind of the beginning of 2024, back end of 2024? I've heard a few dates thrown around. So.
Tom, I wish I knew. I think that is the question a lot of people are asking themselves. I mean, interestingly, if we look at the options market in the US, the bond markets, what they're doing is starting to price in more cuts earlier. And it's a kind of risk-reward bet. If you actually look at where the swaps market are pricing things, they're not looking for those cuts. No. So I think this is people putting on bets, that's probably going to pay out fairly well if they're right. The danger here is no one's looking past that for rates to go any higher. And okay, that may be the case, but there is a risk. We have got a very divergent economic divergence around the world. And I think the danger is that there's still pockets of inflation that could come around and bite. And let's face it, commodities have been adding to a certain deflationary aspect for a while, apart from oil. That looks like it's changing. So I think the central banks are going to keep their doors open for more movements in case. It's madness for the Bank of England to say, right, we're done, as indeed the RBNZ did. But I mean, for them to say we're done and trap themselves in that policy is crazy. So I wouldn't expect the central banks to be particularly dovish this week, apart from maybe the Bank of Japan. But I think this risk of inflation coming back is at the back of their minds. What they do about growth is going to be something else, but commodities, the higher dollar, there's some risks out there to the current narrative, I think.